Many people think digital assets are just cryptocurrencies like Bitcoin. That's a common perception. External coverage often focuses heavily on cryptocurrencies, especially Bitcoin and other speculative tokens, given the significant price volatility seen in recent years. But cryptocurrencies are only one part of a much broader picture. Digital assets are digital representations of value or rights, where ownership and transfers are recorded using new forms of digital infrastructure, such as distributed ledger technology. This can enable faster, more transparent, and importantly, programmable ways to record, manage, and transfer value. For banks, that creates new opportunities to move money and assets more efficiently and to support clients in new ways.
This means value can move across a network without relying on a single central authority. For example, a commercial bank to maintain the record. DLT can be permissionless, like Bitcoin, where anyone can join, or permissioned, where participants need approval to join. This is more common in financial services applications. Blockchain is one type of DLT, where transactions are grouped into blocks and linked together to form a shared ledger. Once recorded, the information is secured and very difficult to change. Tokenization builds on this. It is the process of creating a digital representation of something familiar like a deposit or a bond. The asset itself may not change, but the way ownership is recorded and transferred does. That can make it faster to move, easier to manage, and simpler to connect across systems.
Clearer? Digital assets are broader than cryptocurrencies, and the underlying technology can support new ways of issuing, moving, and managing money and assets, helping make processes faster, clearer, and more efficient. Many people think digital assets are a passing trend. That's understandable. Early activity was often experimental, and public attention focused heavily on speculative cryptocurrency markets. But that misses the bigger shift. The technology and the regulatory landscape around it has continued to mature, creating conditions for more practical, real-world applications. The digital asset story began with Bitcoin in 2008, which showed that people could transfer value over a permissionless, distributed ledger without a bank or central body keeping the records. Over time, the underlying ideas and technology were adapted and expanded. Stablecoins emerged as digital tokens designed to maintain a stable value, typically by being backed with high-quality, liquid assets. To date, they have largely been issued by private, non-bank firms. Central banks then began exploring public sector options such as central bank digital currencies, or CBDCs. Unlike Bitcoin or privately issued stablecoins, CBDCs would be issued by the central bank and represent a direct claim on it. Commercial banks also began exploring tokenized deposits, regulated, bank-issued digital money that remains on banks' balance sheets, preserving the link with lending while enabling new functionality such as programmable payments, atomic settlements, and near-instant transfers.
This matters now because digital assets are moving beyond experimentation towards real-world adoption. Regulation is becoming clearer across major jurisdictions, with the US establishing a framework for payment stablecoins known as the Genius Act, the EU implementing MiCA as a comprehensive crypto-asset regulatory framework, and the UK is developing its own approach to stablecoins and wider crypto-asset regulation. The direction of travel points towards a multi-money future where central bank money, commercial bank money, and new regulated forms of digital money coexist, and where commercial banks continue to play a critical role supporting solutions, innovation, and trust.
Clearer? Digital assets are not just a passing trend. They are part of a broader shift from experimentation towards core modern financial infrastructure. We need to prepare for a multi-money future alongside digital financial assets, so the benefits are fully realized and our customers and clients can act with confidence. Often, people think digital assets are a solution looking for a problem. That's understandable. Not every process needs new technology, and not every use case is a good one. Digital assets are most relevant where today's processes are slow, fragmented, manual, or dependent on multiple parties. At their core, digital assets are about improving how money and assets move, enabling faster, more transparent, and importantly, programmable transfers of value. At Barclays, we're engaging with digital assets in a practical and measured way, focused on where the technology could solve real client and market frictions.
One area of focus is tokenised deposits. We're exploring how a bank-issued form of digital money could support faster transactions, reduce fragmented liquidity, and enable new functionalities such as programmable payments for clients.
We are also participating in the Sterling Tokenised Deposits pilot, known as GBTD. This is exploring how commercial bank tokenized deposit platforms could connect with each other and support new innovative retail and wholesale use cases. Barclays is also engaged across the broader digital money ecosystem. That includes our investment in Finality, which is developing regulated DLT-based central bank money settlement systems, and UBIGS, which is building clearing infrastructure for regulated digital money, including tokenized deposits and stablecoins.
The aim is not to back technology for its own sake, but to understand where digital assets can deliver practical value for clients, markets, and the wider financial system.
These pieces are critical to unlocking the benefits of digital assets safely and at scale. Clearer? Digital assets can create value when the right pieces fit together, and Barclays has a key role to play as the glue connecting traditional finance with digital settlement infrastructure.